In 1944, delegates gathered at the Bretton Woods Conference to design the post-war financial order. While the International Monetary Fund was created to stabilize global currencies, the newly formed World Bank Group was given a specific mandate to eradicate extreme poverty and build shared economic prosperity. For decades, the institution approached this mission strictly as a structural engineering challenge. If a country lacked wealth, the solution was straightforward: build roads, fund schools, and issue loans to stimulate local labor markets. Look at this 1993 World Bank Progress Report. It lays out a clear two-track strategy for poverty reduction, promoting labor growth and investing heavily in social services. In the 20th century, economic development sat in one bucket and environmental protection sat in another. Treating them as entirely separate issues created a massive blind spot that now threatens to pull apart those exact structural gains. Today, we face a new reality. Severe and volatile weather routinely washes away the very infrastructure those historical loans financed. This chart tracks global poverty rates over time, showing a steady decline across recent decades. But approaching 2030, the projection hooks upward, reversing direction. Climate impacts could push up to 135 million people back into extreme poverty. The World Bank Group recently acknowledged a difficult reality. The effort to lift people out of poverty now depends entirely on whether those same communities can survive the changing climate. This convergence was actually predicted internally. In the same year that Poverty Report was published, Mohammed Al-Ashri, a chief environmental advisor, warned that environmental degradation and resource depletion threaten economic development and human survival. Rising temperatures and volatile weather have become the primary variables in global economic planning, posing a direct threat to the stability of entire nations. The link between financial ruin and environmental collapse operates in a brutal, self-reinforcing feedback loop. Step 1 begins when shifting weather patterns create extreme droughts. When the land dries out, agricultural production drops, destroying the livelihoods and food security of the most vulnerable populations. Step 2 accelerates the damage. Because these communities are already impoverished, they lack the capital to buy drought-resistant seeds, build resilient infrastructure, or access basic insurance. Their poverty increases their climate vulnerability. In Step 3, a disaster strikes. A severe flood wipes out whatever assets and physical capital these populations have left, plunging them even deeper into poverty and restarting the entire cycle. Traditional financial interventions cannot function inside this loop. It is impossible to successfully fund long-term economic growth in a system where the physical assets are constantly being destroyed. To interrupt this cycle, the World Bank Group launched its Climate Change Action Plan, a strategy to integrate climate resilience directly into economic planning. The primary diagnostic tools introduced by this plan are called Country Climate and Development Reports, or CCDRs. These reports gather large amounts of local data to map out a nation's specific localized climate vulnerabilities. Look at the Maldives. Their CCDR focuses on protecting the highly exposed tourism and fishery sectors from sea level rise, prioritizing specific green transitions to maintain macroeconomic stability on the islands. In Ethiopia, the reports look completely different. There, the tool quantifies climate impacts on agriculture to map out a specific 10-year priority action plan, helping local farmers move toward low-carbon growth. These reports act as localized circuit breakers. They take abstract global climate targets and translate them into highly specific, actionable economic survival plans. Executing those survival plans requires a massive, immediate reallocation of capital. Of the World Bank Group's total grant volume, 35% is now dedicated to climate finance. Within this, funding for adaptation projects is doubling to protect vulnerable populations. To scale impact, they design green bonds and carbon credit markets, pulling in private sector capital. Integrating environmental resilience has become a strict mathematical requirement for any project seeking a share of this global capital pool. Through initiatives like Mission 300, massive solar farms and sustainable grids will provide electricity to 300 million people across sub-Saharan Africa by 2030. Every future road, farm, and power grid must be built with climate resilience as its baseline design to prevent economic gains from being lost to the next storm. Protecting the environment is the only viable way to protect the economy. It requires absolute systemic collaboration to ensure our global progress survives the weather.